The next arrangement we'll look at is the promissory note arrangement. It's a little bit more complicated, but it is more tax efficient. With the promissory note arrangement, the corporation is now going to buy the life insurance on each of Jill and Steve. That means we're paying for the life insurance with the corporation's after-tax dollars rather than Jill or Steve's after-tax dollars. That's generally going to result in cost savings of about 20 to 25%. So that alone is a win right from the beginning with the promissory note arrangement. Okay, now let's say that Steve dies. The death benefit would be paid to the corporation as the beneficiary of that life insurance policy. And let's assume that it's $1 million of term insurance. This will create a $1 million credit to the capital dividend account for this corporation. Of course, we saw a few slides ago that the capital dividend account allows the corporation to pay a tax-free amount out to its shareholders. So now Steve's shares are deemed disposed because of his death, just like we saw with the Jill example when we looked at the cross-purchase agreement a few slides ago. Section 70 of the Income Tax Act calls for a deemed disposition of capital property on death. So we've seen that Steve has this $1 million capital gain when he dies. He may be able to offset that using the lifetime capital gains exemption, which may allow him to offset up to $750,000 of capital gains. Then his shares will pass on to his estate, which takes on those shares with now an ACB of $1 million. Essentially, they're all tax paid. There's no more capital gain or capital loss waiting for the estate as long as the estate sells the shares for $1 million. Jill now acquires those shares from Steve's estate by issuing a $1 million promissory note. A promissory note is really like an IOU. So Jill just writes a note that says, here's $1 million. It's a negotiable instrument, meaning that as long as the estate figures it has a value of $1 million, it has a value of $1 million. So the estate has taken now fair compensation, and in exchange for that, it will pass those shares to Jill. So at this point, Jill becomes the sole shareholder of this corporation. The estate, Steve, whatever the case is no longer involved. However, Jill does owe the estate $1 million. So the question is, where does Jill get that $1 million from? Now Jill, as the sole shareholder, owns all the shares, and she just has to take care of that promissory note. So how's she going to do it? We're going to have the corporation pay her a $1 million tax-free capital dividend. They will use the insurance proceeds to pay that capital dividend. And then Jill will use that $1 million to redeem that promissory note issued to Steve's estate, so effectively wiping out her debt to Steve's estate. The promissory note will be redeemed, and Jill no longer has to deal with Steve's estate, which was the intent of the buy-sell. We've now got Jill as the sole shareholder, and Steve's estate has gotten the value for Steve's shares in the company. At this point, Jill owns all the shares of the company. Her fair market value is now $2 million, and her ACB is $1 million. It's a fairly straightforward arrangement, a little more complicated than what we've seen previously, but it's reasonably straightforward. We're not taking advantage of any complex tax provisions here, although we'd like to have access to both capital dividend account credits and the lifetime capital gains exemption. What do we like about the promissory note arrangement? Well, it's much more tax efficient than the cross-purchase agreement because now the corporation is buying the insurance. It's much cheaper for the corporation to buy the insurance than it is for an individual to buy the insurance. It allows for use of the lifetime capital gains exemption and the capital dividend account, two measures of the Income Tax Act that allow a taxpayer to generate some tax efficiency that they would not otherwise have. It will increase the ACB for the surviving shareholder, meaning that the surviving shareholder is not going to have a large tax liability waiting for them down the road. And it works very well with multiple shareholders. If we have 3 or 4 or 5 or more shareholders, now the corporation is really taking care of the middleman role here, and we don't have the requirement for, let's say in a 3-person arrangement like we talked about in the cross-purchase, we don't have the requirement for 6 insurance policies to be enforced now. We only need 3 insurance policies. On the downside, it is a somewhat complex arrangement. Not everybody understands that flow from the promissory note to the redemption of the promissory note. The capital dividend account and lifetime capital gains exemption tend not to be part of most people's everyday vernacular. And if the corporation does have debts when the shareholder dies, we have to be careful here that the proceeds of that insurance policy could be attached by creditors. There are some ways around that, such as using a holding company to help create the proper structure for this, but in a basic arrangement, you do run this risk. And then we do have to have the lifetime capital gains exemption and the capital dividend account available for that maximum tax efficiency. Without having both of those arrangements available, it's probably not appropriate to use the promissory note arrangement.